imagine holding a stock where, the physical brick and mortar business is just this practically invincible cash machine.
Right, like an absolute fortress.
Yeah, exactly. But then its cutting-edge digital tech segment is actively bleeding customers to ChatGPT.
It's such a massive structural tension.
Yeah.
I mean, you have the ultimate traditional moat colliding with the ultimate digital disruption.
And it's all on the exact same balance sheet.
Yeah, it's wild.
So welcome to this Talk Tickers deep dive. We are skipping the fluff today and going straight to the core of the Q2 2026 earnings call transcript from Afya.
Right, and if you're looking up the ticker, that's AFYA.
Thanks for that. So they are the dominant player in the Brazilian medical education and digital health space.
And they are truly dominant down there.
Yeah, they really are. And the mission for this deep dive is to cut through all the accounting jargon, isolate the signal from the noise, and, figure out if this is a buy, a hold, or a fold for your portfolio.
I think it is a fascinating study in capital allocation.
Oh, totally.
Because, this company is split between two radically different economic realities right now.
Right, you've got the physical side and the digital side.
Exactly. So on one side, you have this heavily regulated physical education business, and on the other, it's just the absolute wild west of digital healthcare software.
It really is two different worlds. So let's see how those two realities are actually translating to the bottom line.
Let's do it.
Looking at the first half of 2026, the revenue engine seems to be, well, it's humming along pretty nicely.
It definitely is.
Total net revenue hit 1.985 billion Brazilian reais, which that is up 7% year over year.
Right. And just to ground everyone on the currency, they operate entirely in reais, which is abbreviated as BRL.
Good point. Yeah. So all our metrics today will be in that currency.
And bringing in nearly 2 billion BRL in a single half year, that's a really solid top-line performance.
Yeah, it's a huge number. And the bottom line kept pace beautifully, too.
It did. Net income landed at 463 million BRL.
Which is also a 7% increase year over year.
Right, so very consistent growth on both ends there.
But, okay, here is where the math gets a little weird for me.
Okay, let's hear it.
So, revenue grows 7%. Total net income grows 7%. It looks perfectly proportional, right?
Yeah, exactly proportional.
But then you look at the basic earnings per share, the EPS.
Yes, the EPS.
Yeah, that hit 5.10 BRL for the 6-month period, and that's actually a 9% jump.
It is a 9% jump, yeah.
So if the total profit pool only grew by 7%, how does the profit per share jump by 9%? Like, what's going on there?
It's a great question. So think of it like a company sitting at a poker table.
Okay, I like poker analogies.
Right. So they're at the table and they're essentially buying back their own chips from the other players and, well, just burning them.
Wait, burning them?
Yeah, taking them completely out of circulation. So even if the total pot of money in the center of the table, the net income, only grows by a modest amount, the chips you still hold in your hand just became mathematically more valuable.
Oh, I see. Because there are fewer chips overall.
Exactly. They represent a larger percentage of that central pot now.
So they are aggressively shrinking the denominator in that equation.
Precisely. The EPS growth outpaced the net income growth, specifically because management executed a massive share buyback program.
Right.
They basically went into the open market, bought their own stock, and retired it.
Wow. Okay. Do we have the numbers on how much they actually bought back?
We do. Out of a 4 million share buyback program that was authorized last year, they have already executed 2.6 million shares.
Which leaves them with firepower to buy back, another 1.4 million shares by the end of this year?
Yep, exactly. 1.4 million left in the chamber.
So here is your early clue as an investor, right? When management uses hard cash to buy back stock instead of, hoarding it or buying fancy new office chairs.
Right.
They are flashing a giant neon sign that says, we believe the market is undervaluing our underlying assets.
It is the absolute ultimate vote of confidence in their own cash flow generation.
Yeah, it really is.
But, to understand where that cash flow is actually coming from, we really have to talk about the tension we mentioned at the start.
Because top-line growth and EPS growth are really only half the story here.
Exactly. They don't show you the structural shift happening underneath.
Right. So let's pull back the curtain on the profitability metrics, because there is a definite squeeze happening here.
There's a very noticeable squeeze, yeah.
The adjusted EBITDA margin dropped by 190 basis points down to 46.2%. Now, for anyone not staring at bond yields all day, 190 basis points is just Well, it's finance speak for 1.9%.
Right. It sounds small when you say 1.9%.
It does sound small, but in corporate finance, dropping nearly 2 full percentage points in operating profit margin, I mean, that is a serious leak in the bucket.
Oh, absolutely. It's a massive drag.
So what is dragging down their profitability when revenue is climbing so steadily?
Well, to find that leak, we really have to look at how Afya is structurally divided.
Okay, let's break it down.
You essentially have the core and the drag.
I like those names. Let's start with the core.
So the core is their traditional physical medical school business.
Yeah.
And I mean, it is an absolute fortress.
A fortress. How so?
Because the Brazilian government heavily restricts and regulates exactly how many medical school seats are legally allowed to operate in the entire country.
Oh, wow. So it's an artificial cap on supply mandated by the state.
Exactly. You can't just rent an office building, hire some teachers, and start handing out medical degrees.
You'd get shut down immediately.
Right. And because the demand for those medical degrees astronomically outpaces that legally restricted supply, Afya basically has near infinite pricing power.
That is a brilliant position to be in. How many seats do they actually have right now?
They currently have 3,768 operating medical seats.
Okay, and is that growing?
Yeah, that is actually a 6% increase from last year.
Yeah.
It was driven by some organic expansion on their existing campuses, plus the integration of some new seats they recently acquired.
Man, with demand that inelastic, they can basically dictate whatever tuition rates they want.
Which is exactly what they did. They increased the average medical school ticket price by 4% year over year.
Wow. What does that bring the tuition to?
It now sits at 9,443 BRL per month.
Per month. That is a huge ticket.
It is. And the craziest part is, even with that price increase, they actually enrolled more students.
People just keep paying it.
Yeah, they have over 26,000 undergraduate medical students right now. That's a 3% growth in the base.
That's incredible.
And on top of that, their adjacent health science programs, so things like nursing, dentistry, psychology, those grew by an astounding 13%.
Okay, so the physical schools are just practically minting money. They raise the price and the line out the door just gets longer.
It's the perfect business model.
So if the core is performing flawlessly like that, that means the entire 190 basis point margin contraction has to be coming from the digital side of the house.
It is. The squeeze is entirely isolated to their medical practice solutions and continuing education segments.
Okay, so this is where the real drama of this earnings call unfolds, right?
Oh yeah, this is the crux of it. Monthly active users in their digital ecosystem actually dropped 8% year over year.
Whoa, 8%.
Yeah, falling to 212,000 active users.
I mean, losing 8% of your active users in any software segment usually triggers total panic. What is causing the exodus?
Well, the CFO, Luis Andre Blanco, was actually incredibly candid about this on the call. The culprit is artificial intelligence.
Of course. AI is eating everything right now.
Specifically, they have this clinical decision support app called Whitebook.
Okay, Whitebook, what does it do?
Historically, a medical professional would pay a subscription for this app to quickly check things like drug dosages, diagnostic criteria, or, symptom cross-references right on their phone.
So it's basically a premium digitized medical encyclopedia.
Exactly. But now, nimble AI startups are just flooding the market with these specialized models.
Right, and they can do that same cross-referencing faster, often conversationally, and sometimes just for free.
Exactly. The whole AI wave is eroding the core value proposition of standalone reference apps.
Yeah, why pay for a digital textbook when you can just ask a chatbot?
Exactly. Medical professionals are migrating to these new tools, which puts immense pressure on Afya to either cut their prices or spend an absolute fortune to catch up.
Which perfectly explains that margin contraction we talked about.
It does.
They are basically taking the massive cash flows generated by the physical medical schools and setting it on fire in the marketing and development departments just to build a moat around their digital users.
That's exactly what's happening. The CEO, Virgilio Deloy Gibbon, confirmed this directly. He noted that the 190 basis point decrease actually reflects a deliberate investment cycle.
Okay, so they know they're doing it.
Right. They are purposely enduring higher sales and marketing expenses to defend their digital turf. But their strategy to fight back is actually, I think, brilliant.
Really? How so?
Because they aren't just trying to build a better encyclopedia.
They are shifting the battlefield entirely.
Yes, exactly. They are pivoting away from trying to sell Whitebook as this high-margin standalone product. Yeah. Instead, they're sacrificing the price point of those clinical decision tools and bundling that AI functionality directly into their heavy enterprise software.
Which is called iClinic, right?
Yes, iClinic.
Let's clarify the difference between those two for a second, because I think understanding the software architecture here is crucial to seeing the actual investment thesis.
It is the most important distinction. So Whitebook is an app a doctor opens for maybe 30 seconds to check a fact.
Right.
It's easily replaceable. iClinic, on the other hand, is the central nervous system of the entire medical practice.
Oh, I see.
It handles the patient scheduling, the electronic health records, the billing, the insurance claims, everything.
So the switching costs are just completely different.
Entirely different.
Like deleting an encyclopedia app takes 2 seconds, but ripping out the software that schedules your patients and pays your staff, that is a logistical nightmare.
It's incredibly sticky software. Once a clinic installs it, they almost never leave.
Precisely. So Afya's strategy is to make their operational software so indispensable and so loaded with their own embedded AI features that a doctor never even has a reason to open a third-party AI app.
You nailed it. And we are already seeing the underlying metrics validate this exact pivot.
Really? The numbers show it's working.
Yeah, even though the total casual monthly active users dropped, the number of clinical management active payers, so the clinics locked into that sticky iClinic platform, that surpassed 50,000.
Oh, wow.
That is a 20% increase year over year.
A 20% increase in enterprise clients. So they are trading casual app users for hardcore locked-in enterprise clients. That is a trade you make every single time.
Every day of the week.
But building a proprietary AI ecosystem inside an enterprise platform, I mean, that requires serious capital. How is management adjusting their forward-looking guidance to actually pay for this transition?
Well, they are holding the line on profitability while drastically shifting how they actually deploy that capital.
Okay, what are the numbers looking like?
Management reaffirmed their full-year adjusted EBITDA guidance, keeping it right in that 1.7 to 1.8 billion BRL range.
So no change to the profit expectations?
None. But the crucial signal came when they discussed their capital expenditure, or CapEx.
Right. They are targeting, what, 340 to 380 million BRL in total CapEx for the second half of the year.
Yes. And during the Q&A session on the call, an analyst specifically asked them to break down what they're actually buying with that 380 million.
Which is a fair question. For a company running dozens of medical school campuses, you would normally expect CapEx to mean, pouring concrete, buying anatomy lab equipment, or outfitting new lecture halls.
Exactly. Physical stuff. But that wasn't the answer.
Not at all, right?
No. The CFO revealed that capital expenditures for physical properties and equipment are actually down year over year.
Wait, down?
Yeah, the massive acceleration in spending is entirely isolated to intangibles.
And just to clarify for everyone, when a company like this says intangibles, they don't mean patents and goodwill. They mean software development. They are aggressively hiring engineers, securing AI API licenses, and basically writing the code necessary to build that digital moat inside iClinic.
Yes, they are starving the physical expansion slightly just to feed this digital defense.
It is a profound transition for a company that started in brick and mortar.
It really is. And, while we were talking about how they manage their cash, we have to look at a highly unusual anomaly on their balance sheet this quarter regarding taxes.
Oh, yes. This is a fantastic case study in how regulatory red tape can occasionally, just work in a company's favor.
It's so rare, but it's amazing when it happens.
You're talking about the Pillar 2 windfall.
I am.
This is one of those pieces of accounting jargon that sounds aggressively boring, but it's actually fascinating when you understand the mechanics of it.
It really is. Walk us through how Pillar 2 actually moved the needle for them.
So the OECD, which is the International Economic Organization, they recently rolled out this massive global tax framework called Pillar 2. And the entire goal of this framework is to stop multinational corporations from playing a shell game with their profits.
Right, because historically, a tech company could generate billions in revenue in Brazil or Europe, but legally book all the profit in a zero tax haven like Bermuda.
Exactly. So Pillar 2 enforces a strict 15% global minimum effective tax rate no matter where you book the profit.
Which is huge.
Yeah.
Usually when global tax authorities tighten the screws like that, corporate profits take a massive hit.
But Afya experienced the exact opposite.
How?
Because Pillar 2 is really designed to target software and IP holding companies, it includes these specific safe harbor carve-outs for companies that actually have massive physical footprints and enormous local payrolls. Because Afya's core business relies on massive brick-and-mortar campuses and thousands of highly paid medical professors, they triggered these safe harbors.
That is incredible. So they realized the new, stricter laws actually exempted their core physical operations more favorably than the old laws did.
Exactly. The regulatory clarification meant they had heavily over-provisioned for taxes in the previous year, assuming they were going to get hit by this.
Right.
Because they didn't get hit, they got to reverse that provision, recording a one-time 20 million BRL positive adjustment straight to the balance sheet.
That is a brilliant breakdown of the mechanism.
Yeah.
And the actual result of that safe harbor protection is that the CFO expects their effective tax rate for the full year 2026 to settle around 10%.
10%, that is a massive competitive advantage.
It's huge. Keeping your effective tax rate at 10% in the current global environment provides incredibly predictable cash flows for analysts who are trying to model the stock.
Which brings us to the ultimate question for you, the investor listening right now.
The verdict.
Yeah. We've weighed the booming, highly regulated physical core against the costly, margin-squeezing digital AI pivot. We've seen the tax windfalls and the heavy software investments.
Yeah.
So what is the definitive bottom line on AFYA?
Well, the signal here is definitively bullish, but you have to know what kind of game you are playing.
Right.
This is a screaming buy for value and income investors. If you are hunting for a hyper-growth tech stock that is going to double its share price in 6 months, look elsewhere.
The bullish thesis rests entirely on capital discipline here, doesn't it?
100%. In corporate finance, when a company generates the kind of cash Afya's medical schools generate, management usually falls victim to empire building.
Oh, we see it all the time.
They want to acquire other companies just to pump up their top-line revenue numbers, even if the businesses they are buying are wildly inefficient or just overpriced.
But Afya's management publicly tied their own hands on this call.
They did. The CFO explicitly stated their golden rule for mergers and acquisitions.
And what was that rule?
They will not deploy capital to acquire another company unless the deal guarantees a minimum 20% internal rate of return, or IRR.
Okay, let's put that in context for a second. An internal rate of return is basically the annualized growth metric an investment is expected to generate over its lifetime. In a world where the cost of capital is high, demanding a 20% guaranteed return is an incredibly high hurdle.
It's massive. It essentially means they are saying no to 99% of the deals that come across their desk.
Which forces the obvious question, right? If they are generating hundreds of millions of raise and they refuse to lower their standards to buy other companies, where does the cash go?
It goes straight into your pocket as an investor.
Exactly. Because they didn't find any acquisitions meeting that 20% hurdle, they didn't just let the cash sit idle, and they certainly didn't waste it on vanity projects.
No, they didn't.
They returned 106% of their free cash flow to equity directly to the shareholders.
It's just staggering. Let's run those specific numbers because it really is impressive.
Okay, hit me.
In the first half of the year, they generated 423 million BRL in free cash flow. They took that, dipped slightly into their existing cash reserves, and returned 448 million BRL to shareholders through dividends and those aggressive share buybacks we broke down earlier.
Wow. They literally gave back more cash than they generated in the half year.
They did. And they can afford to do that without breaking a sweat because their balance sheet is just so fortified.
Let's talk about the debt then.
Their net debt to EBITDA ratio sits at a remarkably low 0.8x.
Meaning, if they devoted all their operating profit to debt service, they could wipe out every single penny of their net debt in less than 10 months.
Exactly. Furthermore, they are actively deleveraging. They reduced their gross debt from 2.7 billion down to 2.4 billion BRL over the last year.
That's a solid chunk of change to pay down.
And they smartly extended the average duration of the debt they kept to 3.7 years, locking in an average cost of debt at 15.1% per year.
Which, you know, in the Brazilian macroeconomic climate, is incredibly efficient.
Yes, 15.1% sounds high to an American investor, but in Brazil, the benchmark interbank lending rate, the CDI rate, dictates the cost of capital.
Right.
Afya locked in their debt at roughly 106% of the CDI rate, which is phenomenal institutional pricing for corporate debt in that specific region.
So synthesizing all of this data, here's the actionable takeaway.
Where you know.
If you currently hold Afya stock, you are literally getting paid to wait. Management is handing you cash via dividends and increasing your ownership stake via buybacks, while the engineers figure out how to navigate the AI turbulence in the digital software segment.
It is an incredibly lucrative defensive posture. I mean, it really is.
And if you are on the sidelines looking for an entry point, you buy this because it is a low-debt cash machine run by stewards of capital who actually respect the 20% IRR hurdle.
Yep. The physical medical school core is a regulatory fortress.
Exactly. It generates the immense free cash flow required to fight the digital battles of the future without ever putting the structural health of the company at risk.
They are basically funding their own disruption safely.
Which leaves us with one final structural question to consider.
Oh, there's always one more question.
Always. We know their immediate strategy to fight AI is to bundle their tools into the sticky iClinic enterprise software.
Right.
It is a brilliant defensive maneuver for today. But look at the horizon line.
The 10-year view.
Right. Long term, can a traditional medical education operator, a company whose absolute core DNA is built on physical real estate, classroom lectures, and government-regulated seat caps, can that company successfully out-innovate nimble, specialized, pure-play AI startups in the digital healthcare space?
That is the million-dollar question. Or are they permanently destined to play catch-up, forced to drain an ever-increasing percentage of their physical school profits just to defend their digital borders?
It is the ultimate corporate identity crisis. Are they fundamentally an education company that uses software to grow, or are they trying to become a software company that just happens to own medical schools?
Until they definitively answer that question, the tension between the core and the drag will definitely remain.
But as we've seen in the numbers today, there is a tremendous amount of yield to be harvested while you wait for the answer, provided you have a management team disciplined enough to distribute it.
Very true.
That's all for today's Talk Tickers Deep Dive. Keep running the numbers, and we'll catch you next time.